Hello, and thank you for joining another episode of DoubleLine's Perspectives. I'm Phil Gioia, Client Portfolio Manager here at DoubleLine, and I'm joined today by Stephen Wald, Portfolio Manager of DoubleLine's Securitized Products team. Stephen, thanks for joining today.
Thanks for having me, Phil. Happy to be here.
Of course. So we're recording this episode a few days before Halloween, right? And we've certainly seen some spooky things transpire in the bond market over the past month or so. The biggest thing that jumps out to me is that ever since the Federal Reserve cut its target Fed funds rate by 50 basis points on September 18th, we've actually seen Treasury yields rise across tenors. And I think that's a little bit counterintuitive, right? I think the expectation was as the Fed cuts rates or lowers the Fed funds rate, that we should see Treasury yields drift lower. But again, it's been the opposite. And we're looking at a chart in one of our investment team calls recently showing the performance of the 10-year Treasury following that initial Fed rate cut. And this has been by far the worst performance of the 10-year Treasury following that initial cut going back to 1984. So again, a little bit of a divergence between what the Fed is doing and what rates are doing. So Steve, perhaps you could share a little bit of insights on what's been driving that divergence, right, between a lower Fed funds rate but Treasury yields rising.
Sure. Yeah, it's definitely been an interesting time since the Fed meeting. Kind of the old adage, buy the rumor, sell the news, has come full fruition here. Given across the yield curve, rates are up 60 to 70 basis points when the Fed ultimately cut 50 basis points. Part of that is due to strong economic data prints that have come in since the Fed meeting. There's a strong jobs number, there's a strong retail sales number, and a few other data prints that has made Fed expectations going forward to be far less dovish than initially expected. I believe at one point in early September, the market was pricing in 11 cuts to get the Fed funds rate in that 2.75 to 3% area.
Where are we now?
And today, the market is pricing in 5 cuts. So it's been a rapid shift, cut in half in the better part of 6 weeks. So that's been the main driver. That coupled with the election on the horizon, I think there is some markets now pricing in, I think a Trump victory might be possible along with potential Republican sweep. And there are some policies floating out there that have to do with more tax cuts, maybe a potential increased deficit, and that's maybe leading to some long-term Treasury yields rising. Once again, kind of a deja vu of where we've been the last few years.
Yeah, my last episode was with Ryan Kimmel, who wrote that perspective on the U.S. debt spiral. And it sounds like no matter what candidate gets elected, it's likely going to increase the deficit. But to your point, if we do see a Republican sweep, perhaps increasing the deficit a little bit more.
Sure.
But I've had a lot of conversations with clients over the past month or so. And what's been really interesting is there's not a general consensus from what to do from a duration positioning perspective. And what I mean by that is some clients I speak to are totally adverse to taking on any duration, right? They want to stay short duration, buy floating rate assets, buy T-bills, and again, really just adverse to taking on any interest rate risk. And on the other end of the spectrum, some investors I talk to are extending their portfolios durations to the longest they've been in quite some time. So where do you fall, on the duration positioning perspective?
Yeah, I mean, that's what makes the market. And you've seen through the first half of this year that duration really did help you. As you see, the ag actually was up north of 5% on year to date at some point, but now it's up less than 2%, as duration has definitely hurt you over the last 6 weeks. I prefer to be in the duration of 3 to 5 years. I think with CPI trending lower, now in that 2.4% area, you're able to lock in a lot of attractive yields in high quality investment grade assets in that 5.5 to 6.5% yield range, depending on where you are and which sector. And that's really attractive. If you're able to construct a portfolio that yields 6% over the next 3 to 5 years, that's pretty defensive over inflation that's trending towards 2%. That's really attractive in today's environment. And if you look at kind of equity returns over the last few years, obviously they've done extremely well. And I think if people said that they would, if you looked at the S&P 500 and said, would you take a return for the next 5 years at a 6 or 7% annualized basis, I think a lot of investors would be happy with that. And here we are, we can construct a fixed income portfolio, all investment grade, very diversified, and with a similar kind of return and yield expectation versus the equity market. So I like where we're at, and I think this recent rise in Treasury yields is giving you another bite of the apple. Again, the whole curve now yields anywhere from 4.15 to 4.5 on the long end. I prefer that 3 to 5 year duration paper just because you're not going to be as subject to long-term yields rising or falling in any quick manner based on how we've experienced over the last 6 weeks. But if you're able to look through the noise and kind of lock in these yields, it's really going to pay dividends for you in the next few years through what is likely to be a more volatile time given where we've been over the last few years.
And that makes sense, right? So very short end, you have a lot of reinvestment risk. On the long end, you're susceptible if rates do move higher, but kind of in the belly of the curve, we're seeing attractive opportunities. Now, a lot of what we do at DoubleLine is based on relative value, right?
Sure.
So we look at yields, and yields generally are high across different sectors, primarily driven by higher Treasury rates. But when you look at, maybe spreads as an example, where are you seeing some opportunities from a relative value standpoint across fixed income?
Yeah, that's another thing that's been really interesting over the last few weeks since the Fed ultimately cut. There's been a big divergence in terms of credit spreads or even spreads on government guaranteed assets. Agency mortgage spreads are actually 35 basis points wider since the Fed cut, where corporate and high yield spreads are almost at their tights going back to 2005 to 2007. So there's a big divergence. Now it makes sense corporate and high yield spreads are at tight levels given what's gone on in the equity markets. But what's gone on with interest rate vol that's really dampened kind of what's gone on within the agency mortgage market. So I think agency mortgages do look very attractive today. If you're able to buy a government guaranteed asset, 150 over treasuries, it's really attractive. That coupled with a lot of assets in the securitized credit sides, again, assets that typically are in your broad-based benchmarks, such as triple or double A residential mortgage credit or some commercial mortgage-backed securities up the capital structure. If you look at kind of where they're trading today on a 10-year average, they're at a wider basis today than where they've been on average. Where if you do that same analysis on the corporate landscape, they're actually the tightest they've ever been. So you really have to be careful and kind of choose where you want to be allocated within this market. But I think a key thing is to stay diversified. You don't want to go 100% in agency mortgages here today. They could go wider, but kind of barbelling that or inserting some kind of lower vol, higher yielding credit benchmarked off the shorter end of the yield curve can really create a low vol kind of experience for investors while also generating significant income.
So maybe tying it all together, right? Thinking about duration positioning and thinking about the relative value in fixed income. And we're only 2 months away from next year, which I feel like this year has flown by. I feel like as I get older, the days feel longer, but the weeks feel shorter. And that's certainly been true for this year. But talking to investors, thinking about allocating fixed income positioning for 2025, how would you kind of tie it all together, right? What advice would you give some investors for allocating that portfolio for next year?
Yes, I'd lock in yields today. As I've mentioned, take advantage of the recent sell-off in Treasury rates, buy higher quality assets, both on the government side and the credit side, lock in that 6% yield for the next 3 to 5 years while it still exists. While Fed funds is still at an elevated level, as we've seen with strong economic data prints, Fed expectations have become much different than where they were a few weeks ago. That can change the other way too. If we start early next year and all of a sudden we see a few months of weak economic data prints and the Fed looks like they're going to cut 12 times, well, we have huge reinvestment risk on the short end of the curve. So I think it's a good time to lock in that yield, and as I said before, stay diversified. Buy assets that look cheap today, but it's okay to own some of that corporate and high yield paper too. Just make sure you're doing your credit work. You're going to end up getting bonds that pay back at par and earn that carry and kind of make sure you're well diversified and well positioned over the next few years.
Yeah, so to summarize, I think your point being in the belly of the Treasury curve, right, you don't have that immediate reinvestment risk, but you're not so susceptible to rising rates on the long end. And then in the fixed income market where we see relative value, perhaps allocate to some of those sectors that are showing relative value, things like the securitized products markets, but also having some corporate credit exposure, right, being diversified. And doing that, you can construct a very high quality portfolio, right, short to intermediate duration that yields in the mid single digits. Does that sound about right?
Absolutely. You want to be overweight the sectors that look cheap, while also keeping in mind it's important to keep a diversified fixed income portfolio in today's environment.
Yeah, I'm getting a little too old to be trick-or-treating, but that portfolio sounds like a treat to me.
Absolutely.
So with that, Steve, thank you for joining today. I hope our viewers found this informative as they think about their allocations ahead of next year. And for those that would like to learn more about DoubleLine's thoughts on the markets, please visit doubleline.com. Thanks everyone for watching, and best of luck the rest of the year.